January, markets go up on fundamentals, not so much. FOMO, fear of missing out crowd, absolutely. How about those same day options pushing everything up? Now, February just ended, not quite like January, in a downturn, seeing lots of cracks in the macroeconomic data and, of course, my charts. Lots to talk about today, so sit back and let's go. Hello, this is Michael Loftus for Wealth and Wisdom TV, where education is the key to a successful financial future. First time here, I am a practicing financial advisor. We have a registered investment advisory firm, which means we're fee-based, and we do act as a fiduciary. Now, we do videos like this, market updates, just launched a podcast, latest one up here, and also other educational videos, live events, etc. So if you like what you hear, please do consider subscribing, hitting that like button. Now, January, as I mentioned, we went up on fundamentals, no, which is when markets should move, right? FOMO crowd, fear of missing out, definitely helped us push to higher numbers, but these ODTE, same day options, definitively was pushing the markets higher, still moving it in February, but maybe the other direction. So just closing out February, negative month, all right? So what's happened is, no, we are not going to pivot. Some of these reports we're going to discuss, obviously inflation staying sticky, unemployment, etc., is going to keep the Fed higher for longer. So today we're going to talk about, one, where we are on the macro side of things, our cycles, show us some charts, sector spotlight, going back to a favorite, what keeps me up at night, got a few slides there, and then game plan, wrapping things up at the end. So sit back, let's go. All right, kicking things off, if you're new here, two-step process, want to start with our market cycles, okay? They're based on three things: growth, inflation, policy, policy being the Fed, okay? We have been definitively in cycle 4, growth slowing, inflation decelerates, disinflation. Now, you see Fed dovish, that's normally the case, definitely not dovish, more on the hawkish side, okay? That's what makes things so difficult. We've got growth slowing, inflation sticky, and the Fed's being real aggressive on raising rates. Now, we went in that cycle back in late 2021, peaked out in November, started making changes December of 2021 to prep for this cycle. At this point, we're definitely going to be in this cycle through the first 2 quarters of the year, probably in some of the months of the third quarter. So we got a way to go. Now, some of the facts behind that, we've got over 30 factors here, but let's just talk big picture. Growth, right? Part of our themes this year is an earnings recession. So here's Walmart, right? Walmart talks about what's going on with their earnings and, most importantly, guidance. Same thing as Home Depot. Today it was Target, right? Everyone is changing their forward guidance because people are spending less money. So that growth story across the board. Last week, the Philly Fed Index came out, not looking good. Today, Chicago as well, negative, okay? I might be able to show some of those later on in the video, okay? Next up, GM set to idle Indiana truck plant for at least 2 weeks because of slowing demand, okay? So again, we are slowing. American Car Center shutters their doors. Closed down. Bang, that's it, because of bankruptcy and what's going on. And when you look at the consumer, here are car delinquencies, 60 days or more, and it is soaring. Saw a video yesterday from Carvana, and all the cars that are being repossessed. So quietly behind the scenes, we're seeing all this negative data. Okay, now the next piece, of course, is the inflation side of things. Came out with CPI a little bit higher. Last Friday, PCE, which is the Fed's biggest gauge for inflation, which went up. So inflation is not only not going down, which we're looking at disinflation, It's staying sticky, which has the potential to be more of a stagflation type environment like the 70s. Not say we're going there, okay? But that is a big problem. So you've got the growth slowing, you've got inflation staying sticky, not good, and the Fed continues to be real hawkish. We'll see what happens next meeting because we have a lot of hot numbers that have recently come out. So let's bring it together here, taking a look at those charts. Let's go. All right, now we're going to take a look at the charts and some of our signals, all right? We're going to go out and look at 3 different areas. Short term, 3 weeks or less. Midterm, 3 months or more. And then long term, 3 years or less, which would take us to our monthly chart. Now, when I zoom in here, there's a couple things that I do see. All right, first off, you've got a 20-month moving average, okay? Came up against it at the beginning of the month, failed, and went down. That is not positive. Down here's momentum. You can see that negative momentum and going down again, not positive at all, okay? And up here is relative strength, right there about 50, okay? So right in the middle of the road line. But when I look at this chart, I'm going to say that we are negative still on the long term because we are, in fact, on a downtrend. Then we take a peek at the weekly look. I will say we're negative here as well. Is there anything in particular that stands out, right? Same thing. Kind of see this line in the sand. Went up against it a few weeks ago, failed, not a good sign, more of a bearish look, and have gone down, okay? And same thing, negative crossover at this point. So our midterm signal is in fact negative. And then, all right, so next we've got the daily chart, okay? 3 weeks or less. What are we seeing here? Anything stand out? Well, one, you can tell that we're still in a downtrend, okay, across the board. Now, we had this bounce, 10%, not uncommon. Bear market bounces, 2001, we had 11% or more, okay? So anything else sticking out here? You know, you can see companies above or below 50-day moving average. That is sloping down, so more of a bearish look. You know, big thing this last month or year to date is volatility. There hasn't been much. That's because of these same-day options. You can look up ODTE, zero date to expiration options if you want more details, or look at my last video. I'll put a link here. I talked about that in detail, but they are moving the markets, number one, but they're also suppressing volatility. One of the reasons why we sold our VIX holding, because we're not getting a true holding. So when I look at this, still in a downtrend. You could call it market neutral, but with a bias to the downside. So 2 are negative, 1 is kind of neutral. So short term, again, which would be the trade, 3 weeks or less, is definitely neutral. So from here, let's go to Sector Spotlight. So there's not a lot to talk about in Sector Spotlight because there hasn't been a lot of places to go here so far this year. But one of the big conversations I've had has been around bonds, okay? Specifically long-term bonds, and I look at 7 to 10 year, which is intermediate, 20 year, and then the long-term bond in the 30-year range, okay? I do think this is our biggest opportunity this year. It just has not yet presented itself. Why? Okay, you can see in the last week or so, we've had this push higher because of inflation. The bond market has really been driven by inflation. It seems like, okay, a definitive consolidation. Last couple of days, slightly down, okay? But I want to see this move to the downside more before I start adding it to our portfolios. And I'm going to talk about something called ultra short bonds later, very different. These are based on longer term treasuries where, again, right, when the yield goes up, price goes down. That's why everyone in 2022, starting in 2021, we're losing money on bonds, which is why we have not been in bonds, because they have in fact been a bit of a loser. So the next thing I'm really looking at is precious metals. Excuse me. So we had a really nice run. When you look at this, we started adding in October, and you can see that we are still in an uptrend at this point, okay, but the trade, 3 weeks or less, had broken. Okay, so a couple things here. One, we had trimmed when we got up the high here, felt we went a little bit too fast, too long, okay, too long mean to the upside over a long period of time. So we cut our positions here, really holding kind of a minimum 3 to 4% type position, okay, which has worked out well. Now that being said, had a nice move today. It looks like we have found a bottom here, okay, and we might start adding to gold again. Now, in the whole precious metal space, which is a big part of our theme this year, it's gold, it's silver, gold miners, silver miners. We've cut gold miner juniors, cut gold miners to an absolute minimum position. Same with silver. They have all gotten hit in the recent time frame. So why is that? Okay. So I'm looking at a couple different reasons. The first thing, down the bottom, and I'll zoom in, okay, and you have what's called a correlation chart. So correlated means you move together. Okay, so I have a correlation to the 10-year Treasury. So the 10-year Treasury and gold, how do they work together? Now, right now, we are in a negative 0.93. So they are negatively correlated, meaning when bond yields, okay, have been going up and price has gone down, right, that's a problem. Bond yields up, gold down. Okay, they are that closely correlated, which is why this recent move is not surprising because of what's happening in the bond market. Now, the same can be said for the US dollar. It's one of our holdings. There we have a negative 0.98%, so almost 1-to-1, totally uncorrelated. So the US dollar has gone up this month, okay, actually the last 3 weeks, all right, which has affected gold. So kind of a, you know, do you want something to win or not? We're waiting for this to break down. And again, we feel that gold is really going to be a big opportunity as we go forward. We talked about China as one of our themes this year. We're building some positions there. But here, this is FXI, which is large cap China. It has gone up but broke trend, okay? So we've cut our holdings here to a minimum. Still feel that China can go up. Why? Because they're opening up. And they're one of the few countries that is looking at cycle 1 right now as we head into the next quarter. So they're growing and they're pumping in a lot of liquidity. The problem is it's very correlated to the U.S. markets right now. So it has lost its footing. I've pulled away my holdings. I'm waiting, but still feel that as we go further, we'll be able to take advantage of China. But to be determined. Next up, what keeps me up at night? So we're bringing back an oldie but a goodie. What keeps me up at night, okay? Generally sleep pretty well. When you have a process, and this is very process driven, it helps you to stay away from the emotions and focus on the data, okay? So when I look at this came out today, which is consumer confidence. We're looking at a 108 number, and we came in at 102. Okay, the red areas, okay, when we go lower are recessions, and you can see in previous cycles when consumer confidence starts to go down, we will generally head into a recession. The next one is confidence expectations, okay? Basically the spread between expectations and present situation, okay? Now this fell to negative 0.83. Same thing when you see the reds, when we go this low, okay, specifically below 0, all right, we have headed into a recession down the road. So another one of those indicators that I'm looking at and showing me that trouble could be potentially ahead. To be clear, we are not in a recession as of today, but we're seeing a lot of signals, as I'll show you, that they are coming. Next up, we have what's called the misery index. Not really a good one, right? Combination of unemployment and CPI. Okay, a higher misery index suggests the economy is struggling, which can lead to rising prices and also unemployment. Okay, same thing here. As it rises, now here it's the gray boxes, is when we go into a recession. So we have come down, starting to come up again. So another signal that I'm continuing to watch. Talked about this already. This is the Philly Fed Manufacturing Index, we were negative 0.89% the month prior, so that would be December. Okay, we're looking for about a minus 11% and hit a whopping minus 24.3. So big miss there. Mentioned today, Chicago came out a miss there as well. So the manufacturing side of things are slowing, confirming some of our signals here. Okay, next up, leading indicators. I'll zoom in here, right? It's a composite leading indicator designed to provide early signals of turning points in the business cycle. Fluctuations in the outpoint gap, i.e. fluctuations of economic activity around its long-term potential level. Same thing, right? When you look here, gray bars are recessions. When we go low, okay, below this 99-ish number, each time we've gone below, it has shown us that we go into recession. Not in one yet. Once I repeat myself. All right, next up, if there's anything that keeps me up at night, it would be these same-day options, ODTEs. You can see they have been around, but not to the level we're seeing this year. Yesterday, 46% of all activity was same-day options. Massive. And we're seeing big purchases going on out there. It's amazing the amount of risk that some of these hedge funds are taking on. So at some point, like last Friday and today, they went the other way, meaning they were buying call options through December into January, and in early February, and then now they're doing put options. So they really can move the markets, and you have to be aware of what's going on here. Next up from Quill Intelligence, we're seeing bankruptcies are starting to go up. Again, these are things you're not hearing on major TV, and you can see, okay, on a percentage basis, and we're right there as we go further. We've had the most bankruptcies so far this year than we've had in quite some time. Next up, how overbought are we? Oh, we've had this correction. Yeah, but hold on. So what we're showing here is the S&P, and then we're showing PE ratios of 20, and then fair value, which is 15, and then 10 I don't even have on here. I mean, it's here, but I didn't put the percentages. Bottom line is we've had this everything bubble, okay, where PE was about 38. We're still very high. Now, if we were to get to 20 PE, that would be about minus 8%, which is around our October lows of last year. But if we were to get back to fair value, that would be 28.06, which would be 31% from here. So not saying it's happening, but that's the kind of risk that is still in this market. Wrapping things up, yield curve, 10-year Treasury minus 2-year has 100% predictability on recessions. I keep using that word, but again, we're not in one yet. Okay, yesterday we hit minus 8.6%. Today we're negative 0.88%. When you invert, between 12 and 18 months is when you see the next recession. Now, we inverted back in July of 2022. So this indicator I look at every day. It continues to go down and is very, very concerning. All right, so let's talk about game plan and what we're doing. So number one, cash is king. Now, with rates going up, we've got some pretty attractive rates on money markets, 4% and a little bit above, which isn't too bad. But we also have some ultra short bond funds. Unlike those long-term bond funds, ultra short, like a 6-month, is paying 5.07 right now. Okay? So ultra short is less than 1 year. We've got some of our ultra short bond funds paying between 4.75% and 5.47%. We've got a blend of those, which is a big part of our portfolio right now. I'm willing to wait out this volatility, see where things go before we start adding on. And I think our best opportunity is that bond gold, right? We see bond yields go down at the same time prices go up and gold prices go up, and feel that will be our best opportunity going forward. Hope you enjoyed this. Thanks for watching. Michael Loftus, Wealth and Wisdom TV.